Famed investor Bill Ackman recently confirmed his SPAC company, Pershing Square Tontine Holdings, is in discussions to acquire 10% of Universal Music Group for approximately $4 billion US. This values UMG at 35 billion euros or $40 billion US at the current exchange rate. A very big valuation, especially for what is supposed to be a SPAC transaction. And the announcement wasn't exactly taken well by investors, with the stock dropping 13% before climbing back up again to recover some of its losses. And I think to a degree, the bearish view may even be justified. And there's a couple reasons. Firstly, just how complicated they have made the transaction, changing it from a typical SPAC merger to something that's more complex, leaving room for a lot of uncertainty in investors' minds. And then secondly, the valuation of the company. It seems punchy at first glance, 35 billion as an enterprise value. And then you also realize that PSTH, the SPAC stock, is trading at 15% above its cash value or its net asset value, meaning that the multiple you're paying if you buy through the SPAC now is an even bigger multiple than the valuation that Bill Ackman is setting out for it in the first place. You couple this with the fact that UMG is going to be going public anyway on the Amsterdam exchange, they've already said, and we'll get into that in a moment. So there's the possibility that you could buy it cheaper directly through the Amsterdam exchange, not even through the SPAC merger, but there's also the possibility that you could be buying it at a higher cost. So in this video, we're going to cover all of those three concerns in some more detail. And then to summarize at the end, I will give you my thoughts on the potential transaction and if I feel it's a good investment opportunity today. Right, so firstly, let's explore the transaction details and its complexities. And we're going to listen to a short clip first from CNBC, which I feel breaks it down well, although still leaves a lot unanswered. And then we'll go over it on the press release in a little bit more detail.
Bill Ackman's big play for a piece of Universal Music Group through his SPAC Pershing Square Tontine Holdings. I spoke with Ackman a little while ago. He told me he was very excited about that deal and that he expects it to be signed later this month, likely by June 22nd. It's a complex deal, as you've heard, for sure. But if you look at recent analyst reports, as I did, it would suggest that Ackman is getting a pretty good deal. Goldman, for example, in a report published last month, right here, they put Universal Music Group's valuation $44 billion, whereas Ackman's deal would have an enterprise value of some $35 billion, a significant discount, at least by Goldman's calculations made last month. Further, if you look at an apples-to-apples comparison to where, say, Warner Music currently trades, the price Ackman is paying is about a 10 to 15% discount, and Warner is the number 3 player in the industry behind both Universal and Sony, according to data I saw from earlier this year. It's also a more levered company in comparison with Universal and comes with fewer voting rights for shareholders, given that company's control structure. By comparison, Universal has the most market share in the U.S., about 41%, and 30% market share globally. It's also been taking share. Margins have been increasing as, like many players in the space, it's been benefiting from the tremendous growth in streaming. But there is more. Ackman's investors will also get roughly $5 in cash in what remains of Tontine, which essentially now becomes a smaller version of itself, with $1.5 billion in cash to go look for something opportunistic to buy. And they'll get an opportunity to participate in what Ackman is calling a special purpose acquisition rights company. It's a mouthful, or a SPAC, which will trade on the New York Stock Exchange, and what is essentially a long-dated option or warrant to take part in the next deal. Unlike a SPAC, though, there's no time limit on when Ackman has to find a target, which means he doesn't face that pressure to do a deal, and investors get to opt in if they like what he ultimately finds. In other words, they don't have to put up any money up front, and if they don't like the deal, they don't have to participate and can sell. Take a look at shares today of Ackman's SPAC, Pershing Square Tontine Holdings, down by about 11%.
Okay, so as CNBC say, it's a fairly complicated transaction and not what investors were expecting. I'll just summarize what was said there and essentially what you'd be getting by buying PSTH stock today. So they confirmed that they're discussing to acquire 10% of Universal Music Group for approximately $4 billion. Now, they plan to distribute the acquired shares to PSTH shareholders later this year because unlike a usual SPAC transaction, the ticker symbol PSTH isn't just going to change to UMG as of the merger date. UMG are actually going to list themselves on the Amsterdam Stock Exchange, and the shares which PSTH acquires are going to be distributed to shareholders on a pro rata basis. Now, because that $4 billion isn't actually as much as the capital that was raised initially for the SPAC, they're going to have to leave $1.5 billion in cash, which is going to be in the form of PSTH RemainCo, another separate company, which is going to reflect $5.25 per share in cash, and that is going to chase after another acquisition. And then lastly, and what seems to have grabbed most people's attention, is this new formation of a SPAC and Pershing Square SPAC Holdings. Essentially, what Ackman's doing here is distributing out transferable rights to purchase shares in this new SPAC company. The SPAC itself is not the same as a SPAC in the sense that people aren't committing capital up front without knowing the company in which the SPAC will merge with. Instead, the SPAC intends to issue rights to shareholders to acquire the SPAC company at its net asset value or agreed valuation only after they know which company they're in a definitive agreement to acquire. So it's slightly different in that sense. And then also it carries a 5-year waiting period rather than just an annual limit or a year's limit to find a company to merge with. So it benefits Ackman in that sense, but then it also benefits shareholders in the sense that they don't have to commit capital up front. They're just given a warrant to purchase. And to be honest with you, I can see why some investors are a bit disappointed with this press release. I think they were expecting, a full company acquisition. They weren't expecting this to happen. Maybe it's reflective of the environment we're in. Too much money chasing after too little amount of deals. It definitely does seem that way. And apart from the UMG deal, nothing's really changed. Everything else that you're getting in this transaction, from the $1.5 billion and $5.25 per share that's going to remain in cash, as well as the SPAC company and the warrants to purchase that company when it merges, again, you're just betting on Ackman. So nothing has changed. You're still betting on Bill Ackman, really, if you buy PSTH stock. And maybe that is what some people have got fed up with, although a lot of people seem to be happy betting on Bill Ackman in the first place. And so what I think is important at the moment is that we focus on this initial deal, this Universal Music Group deal. That's the only tangible thing, really, we can analyze at this point. Everything else is going to be remaining the same in terms of betting on Ackman to find another deal. So if we look at Universal Music Group here, I've got this workbook that hopefully will give us some insight into the transaction itself and the value proposition for Universal Music Group on a financials basis. Now, we've also got Bill Ackman's thesis here that he did give us in the press release, so we'll run through that as well. He gave us some narrative as to why he chose, or why he's looking to choose, Universal Music Group. And what I also think is very helpful to provide some context into this deal will be to understand Bill Ackman as an investor and his rules for investing, because he is known as an activist and quite a pushy investor, someone who's very much involved. But in his more recent years and current form, he has a rule set, 8 rules specifically, that drive him to be more like a traditional value investor and not stray off the beaten path. So let's do that now, actually. The 8 rules for investing. So Bill Ackman's 8 rules. First of all, simple and predictable businesses. Second, free cash flow generative. Third, he looks for a dominant market position. Fourth, large barriers to entry. 5, high returns on capital. 6, limited exposure to non-controllable extrinsic risks like an economic downturn. 7, strong balance sheet where outside capital is not necessary. And then 8, an excellent management team and good governance. So that gives us some context into what Bill Ackman's looking for in a company. What I will say is a lot of these rules are mainly there to stop him and prevent him from making risky bets, in which he has in the past, and that's when his fund has lost a lot of money. But at least that provides some context into what he is looking for. Now, if we look at the thesis for the company before we get into the financials for Universal Music Group, we can see how the thesis actually runs in line with those rules and where the value proposition is. So first of all, Universal Music Group, he calls one of the greatest businesses in the world, led by Sir Lucian Grange. It is one of the most outstanding management teams that he has ever encountered. So first of all, we've got that great business, and we've got that great management team that he's looking for. Importantly, UMG meets all of the acquisition criteria and investment principles, like we've just covered. It's the world's leading music company, so dominant market position, and it's in the royalties business, which is what he loves. He has these restaurant companies which earn royalties, Hilton, the hotel companies that he owns, which earn royalties. So really, these businesses are capital light businesses that just license out their product and they earn royalties on it. And there's a growing demand for music globally as well, which he mentions. Now, we minimize that slightly. He has given us some more bullet points as well as to his thesis. So again, number one, in the industry, their market share is somewhere in the region of 30 to 40% globally, I believe. Iconic world-class management team, massive growing total addressable market. He says everyone loves music. That is very true. Streaming is definitely on the up. I don't know if I'd say it's massively growing, but it's definitely growing, and it is already a very big market. Global consumer adoption of streaming will generate many years of growth. So that is the value proposition. Although we haven't exactly seen that huge boost in growth, the average has been 9.5% over the past 3 years. We definitely are seeing some growth. But he also sees their competitive advantage in the irreplaceable owned intellectual property and must-have content that they own themselves. No one else owns it. They're the only one who earns royalties off of it. And then from this, they've got very predictable and recurring revenue streams that require minimum capital despite high growth. So minimum outside capital, another one of the qualities in which he looks for. And then lastly, which is where I think the value proposition really is for this company, if I were to point one out, is the significant fixed cost expense up front. The cost base is all fixed, not variable, which allows for long-term margin expansion. And this is mainly driven through streaming at the moment, the way in which music is going. We've seen this operating margin here expand in the past 3 years, up from 14% all the way up to 18.5%. So we've seen some good expansion. Maybe he's guessing that they can get up into the 20s, maybe 25% by 2025. And I think it's probably where Bill Ackman sees most of the value rather than in terms of top line growth. One thing I will say is that this, of course, isn't a transaction that's a done deal yet. This is just a discussion. They both have confirmed discussions, so we know it's taken place. It's likely it will get done, but it could not get done. Now, if a merger is announced, then we're definitely going to get more detail than what is just here, and we'll probably see it in the form of an investor presentation. Ackman and Pershing Square will definitely point out what they see as the value proposition. That is the point of these SPAC mergers after all. They tell investors why they were acquiring this specific company, and we may get more information out of that and see that the only value proposition isn't just this margin expansion, and there's other stuff that we haven't seen or maybe aren't able to see yet, because at the end of the day, UMG is a privately owned company. They're owned by Vivendi, which is a public company, but they only publish limited segment results for Universal Music Group, which is what we're working with here. So if I just edge over now to the financials and the forecast, try and give you a quick valuation analysis, DCF analysis, just to give you an idea of maybe what this company's worth and if Bill Ackman is buying it at a fair price and therefore shareholders are getting a fair price for the stock. Now, currently at 35 enterprise value, 35 billion euros enterprise value, which is what he's proposing they're going to buy 10% of the company for. That's roughly 25 times EBIT or 25 times operating income at the moment. Not a drastically high price considering the S&P is up in the 30s and 40s, but for a company that's growing top line at 9.5% on a 3-year average basis and only grew top line at 4% last year, you could say it's a fairly punchy valuation, especially for what was a private deal. Now, with Universal Music Group set to go public on the Amsterdam Exchange in the near future, I think they've said July or August, September maybe, they could be trading or could be looking to IPO at a bigger valuation than this. I suspect that they are looking to go at a slightly bigger valuation than this. Otherwise, Bill Ackman may not look at doing the deal. So there may be that arbitrage opportunity there, but I think it's clear in most people's minds that 25 times earnings when the company's growing earnings at around 9.7% isn't exactly a steal. But I guess if you have very simple and predictable cash flows, then the present value of any asset is the cash flows that it can produce over a certain period of time. So maybe he's discounting on that basis. Right, if we forecast out though for the next 5 years, just look at a scenario which maybe Bill Ackman is seeing, where the value exists for this company. And I've gone with 10% growth for next year, and then the following years just growing at 7.5%, getting them to around 10.5 billion euros in 2025 as a revenue number. Now, I've put in that margin expansion, I've just penciled that in as 25% as of the end of the period. That gets us to around 2.6 billion in operating income, so doubling from where they are now. I have to believe that if Bill Ackman is looking to purchase this company, and this was the company he was getting so excited about, he must be seeing something like this on the margin expansion side, because I'm really not seeing the growth opportunity on the top line. So a double in earnings would be pretty good. That would usually lead to a good value return to investors. So we're going to go with that. Now, I've gone with 25 times operating income at the end of the period. Gets the company to a value of around 52 billion in 2025. Now, we haven't got free cash flow numbers, so we don't know their capex numbers and things like that. But I've penciled in here that they can convert around 70% of their earnings into free cash flow. There's a good chance that they will be able to actually convert more than that number, say 80 to 90%, just because it is a capital light business for all the reasons that he talked about there. They've got a fixed cost basis, so I don't imagine capex, the maintenance capex of the business, to be a very high amount. But we've penciled it in as such, and then discounting all of that back to today, it looks like what he's seeing is a 12% return. Now, if I went with my 15% required rate of return on this, it would value UMG on the limited information that we have at around $30 billion as an enterprise value. Now, we're paying $35 billion, so if we're looking at that on a return basis, I'll just change this to estimated return, which is what it is, we're looking at around 12%. And I think if you're someone like Ackman, who's a $1 billion hedge fund owner, what they're looking to do is beat the other opportunities that are out there. So he could be looking at that, and this is a danger with investing and leaving your money with someone else for them to do the work when you don't know exactly what the company is that they're merging with. You don't know what their target returns are. Bill Ackman could be looking at this and going, with the environment that we're in, 12% is a good estimated return. Now, it's a predictable 12% return as well. That could be his thesis. Now, fortunately, this deal, or 12%, doesn't quite cut it for me. So unless I see something in the investor presentation and in the press release when a deal is actually agreed that makes me think, wow, there is a much bigger value proposition here, then it isn't probably something that I would go with or look to invest in. Then also couple this with the fact that the overall transaction makeup, the three-legged stool that is the SPAC, this transaction with UMG and the 1.5 billion that's going to be left in cash, it almost sets us back at square one with the other two things where we're relying on Ackman to find a deal. And finding a deal has definitely proven hard for him on this occasion. In my opinion, there's going to be other things out there that are probably presenting better value, and they're much less complicated for you to wrap your head around, therefore providing less uncertainty. But an interesting deal nonetheless. More information will come out very soon, and if we do get some more information that's exciting or either changes the picture, I'll do another video just covering all of that. I hope you enjoyed watching it, guys. Just a quick overview of the potential transaction with PSTH, Bill Ackman's PSTH and Universal Music Group. Let me know in the comments below what you think of the deal. If you think I've missed anything here, if I'm not seeing any value that maybe you're seeing, I'd be keen to know. If you enjoyed the video, subscribe to the channel if you haven't already. I'd appreciate a thumbs up or like on the video as well. That really helps the channel out. I'll leave this worksheet, valuation model, on the Patreon with some of my thoughts as well. So if you're interested in supporting the channel, then go ahead and check out the Patreon and all of its various benefits. But until next time, I will see you all in the next video. Good luck with your investments.